Thanks everybody for joining today. We are going to talk about the importance of asset allocation and how to analyze your investment holdings inside of the WealthTrace software. I am Doug Carey. I'm a chartered financial analyst and I am the founder of WealthTrace.
And I'm joining Doug today. I'm Dan Rooker, co-CEO of WealthTrace. For those of you who can stay through to the end of today's webinar, we've got some exciting announcement about WealthTrace in Q4 2026. Camille will be in the Q&A section. If you look at the bottom of your screen, there is a Q&A chat box. If you don't see it, click on the more three dots, and that should show the Q&A chat box. If you have questions today, just type them there. We will answer them as we go, in writing or live, as well as for the view. If you look to the top right of your screen on a desktop, you should see a button named View. You can change the view so that you see our videos. If you want to see us, you can change it so that you just see shared content. If you have other questions, throw them into the Q&A, even if it's operational, and we'll see if we can help.
Yeah, and also in the Q&A at the end, I will be answering some of the more elaborate questions as well. So be patient if we don't get to your question right away. All right, agenda today. Well, I want to explain why your asset allocation is so important. We'll talk about diversification and how it helps your portfolio during volatile markets. We'll go through the value of being able to view all of your holdings and understanding what you own. We'll talk about reallocating investments in the future and how you can do that inside the WealthTrace software. And we will also use WealthTrace to view your asset allocation or a sample plan that is, all the holdings one owns, and then we'll run some asset allocation scenarios. So the importance of knowing your asset allocation, it might go without saying, you have to know what you own, but it can be a little more complex than that. If you don't know what you own, you really are flying blind and it can be dangerous. Some people do think they are already diversified, but maybe they're not. Your holdings could be heavily tilted towards one sector, one single company, maybe a fund type, or maybe you're heavily allocated into one asset class.
Yeah, I'd like to piggyback off of flying blind and put it into terms that we all know. We drive every day. We plug into the GPS where we're going. And if you looked at Google Maps or iMaps recently, you'll see that, it defaults to the car. But I would say asset allocation is about the mix of vehicles that you might use to get from point A to point B. So you might be on a bike, you might walk, you might drive. And depending on how you get from point A to point B, that determines the speed at which you arrive and the risk that you take to get there.
Yeah, that's right. Good analogy. So this comes up quite a bit. I think it can get confusing what rebalancing versus reallocating means. So I wanted to talk about it right off the bat. They're different. Rebalancing is a little more of a simple idea. And really, rebalancing just means you want to keep your asset mix the same over time. Whereas reallocation allows you to allocate your holdings to a completely different asset mix at some point in the future.
So you have this pie chart on the right. This is an example of maybe a typical retiree portfolio with 60% stocks and 40% bonds. And in the middle, this is an example of maybe some future point in time where the stocks have outperformed the bonds. And if you haven't rebalanced, then you have more in stocks than you have in bonds. And the active rebalancing is selling from, in this case, in our examples, selling 10% from stocks and buying 10% in bonds. And that's something that should be done on a continual basis. It is different from reallocating, and then I'd go a step further and say that in the world of rebalancing, you might have a lot of different investment accounts that have different time horizons. You might spend a retirement account at a different point later than maybe a non-retirement account. And so your investment mixture of stocks and bonds probably is different in an IRA than it is in a non-retirement account. But your overall allocation, like we're showing on this pie chart example, maybe it balances out too. a mixture, a target that you try to get back to on a periodic basis.
Right. And not to put the cart before the horse, but we'll show this in WealthTrace, you can actually rebalance or it will rebalance at the account level, which is great because many people like to be a little more aggressive in certain accounts they won't touch, as Dan mentioned, for years and years and years, whereas they might have an account that's their spending account, of course, that will be more conservative. So I just put together a quick little graphic here for the problem with allocation drift when you don't rebalance. And this is just a simple example of 60/40, again, stocks and bonds, where stocks outperform bonds by 4% over 5 years, and they're already at a 65% stock allocation versus their target of 60. So that's just 5 years and that's just 4%. Imagine over the last, 15, 20 years or so, when there have been years where stocks have outperformed bonds by 25%. Imagine how quickly that mix gets really out of whack. So it
But
can creep up on people.
why is that a problem, Doug? Like, if I have done really well in my account because I just let it continue to have more and more stocks, what is that? What does that do for me? Or I mean, it seems like I'd be further ahead based on
Yeah,
that.
so the problem with probably the most extreme example is you have just retired and you need to spend money in the accounts and you think, okay, look, my I have this much money, I'll be fine, but you don't realize it's your stocks have gone up to 85% over the last decade or whatever, 85% of the portfolio. And then the market tanks and stocks are down 30 or 40%. So that's kind of sequence of returns risk mixed in with this idea of rebalancing. So that would be very painful when you thought you were going to be 60/40 or 50/50 and you're actually
Hmm.
like 80 or 90% in stocks and now you just lost, twice as much as you expected in your
Yeah,
portfolio.
yeah. You don't want to drift off into the horizon. That's just that sequence of returns risk is real in retirement. It's like the meat and potatoes of why you don't just let your portfolio go.
Yeah. Yep. Okay, back to diversification. Well, it's a word that gets used a lot in finance for sure. But what is it really? Well, I will tell you what it's not. It's not having your money spread out around amongst many brokers. I've talked to people who say, "Hey, I have money at Fidelity and Vanguard and Schwab and E-Trade. It's great. I'm super diversified in terms of risk of the brokers." Well, that's not really true, and that's not super helpful. In fact, it probably makes your life more confusing. Diversifying amongst banks might be a good idea if you have a lot of money in banks and you go over the insured limit, uh, perhaps. But that's not what we're talking about here. We're talking about diversifying for your investments. So spread out across different asset classes that don't all move together. That's the key. You don't want them to move together, especially when the market turns down. So we're talking about, being in US stocks, US bonds, perhaps some foreign international stocks and bonds, maybe real estate, growth value. That's diversification.
I would agree with that. I think that diversification is just misidentified often. It's very but this infographic is perfect. It gives you an idea of what is diversification and how what you already have may be diversification, but what you want to be careful with. And I'll step ahead on this lower correlation comment is you want to be careful within your accounts about positive correlation. That is owning funds that act and behave in tandem with each other. They don't zag away from each other, they zig with each other.
Right. And so, unfortunately, a lot of people think, well, I own the total stock market index fund and hundreds and hundreds of stocks, and so I have to be diversified. Well, guess what? Most of those stocks are correlated above 90% with each other. So, that's the key. The correlation is really important to know and or at least have an idea, right? Because you might actually not be as diversified as you think. In fact, I ran some. Actually, I'll hit that in a second. But let's just look at some scenarios I ran in the WealthTrace software where there's this model portfolio where they're 100% in stocks. This couple's 55. They have 2 million in assets. They'll live to age 85. So it's a simple little portfolio I ran. And I wanted to see what happened if they were super aggressive. Well, guess what? No surprise, their median in the Monte Carlo simulations was the highest, but look at their probability of running out of money at some point. It's 20%. It's pretty high. As we go down in risk level, you can see the probability of running out of money starts to decrease, which is good. Now, will their potential, maximum net worth go down as well? Yeah, of course, right? Because they're not taking as much risk. But really, the goal for most people is don't run out of money, right? Don't blow yourself up trying to have 10 million instead of 2 million or 3 million at the end. That's what most people are shooting for. So that's why being able to run these models, see your true diversification is so important, and you can kind of home in on a best solution, which in this case is, well, not sure exactly the best, but we know that the 60-40 split is way less risky than the 100% stock split. I also want to talk about correlation, unless Dan, you wanted to point something out here.
Sorry, Doug, I was just finishing up typing a question and an answer to
Okay.
Lewis in the chat. Um, on correlation, I think my comment before about just the um, what I would say about on correlation specifically with this in front, we're not claiming that diversification gives you uh, better returns long term. In fact, a non-diversified portfolio of one holding could outperform a diversified portfolio long term. But what that creates is it puts you into the what we call outliers. You're either going to do really, really well or really, really poorly. You're more likely to end up in an outlier outcome with a non-diversified portfolio of doing really well or really poorly. More likely to do that than end up in the middle. Ending up in the middle is what diversification helps do. So uh, I don't have to call out some single stocks or single digital currencies out there that we all know about. Those are going to create outlier outcomes. And if you want to take those risks, I would urge you to take those risks within the lens of a smaller part of your portfolio than like what we're talking about here.
Yeah, so let's talk about correlation a bit more. This is really important inside the WealthTrace software when running Monte Carlo analysis. And again, it's one of those things that I don't think gets discussed enough. And that is the correlation, especially in US stocks, has gone up over the last 20 or 30 years. It's just a fact. And I ran some different stock indices. These are actual ETFs. The correlations over the last 10 years using their monthly returns. And look at how correlated some of these different ETFs are, like large growth, super correlated with the S&P 500, almost indistinguishable. And you can see that a lot of these are 90% or higher. We really don't start to get some lower correlations, in the 80s until we start looking at value, especially small cap value. That's a nice number right there. 80% correlated with the S&P 500 is not bad. So it's really valuable to understand how um, different are the correlations amongst the assets that I own. Okay, so we've talked a lot about the theory and why it's important to diversify and understand your holdings. But I want to show it in the software, of course, and how you can utilize WealthTrace for this. Oh, yes, and wanted to mention that a lot of this information, and I'll point it out again, it does help if your accounts are linked, because we can pull in a little more information on the asset classes, but we'll get into that when I get into the software. So let me go to the software.
Just while Doug's doing that, just a comment on linking. It is very um, links break. All of you have been using WealthTrace a while. You know that, and it's not necessarily us. It's the institution that your account is at. You update your password, but more often it's they're updating their cybersecurity in the background, and that breaks the link. So it hopefully most of the time it's just an easy fix. You log back into WealthTrace, you relink the account, and then we pull in historical transaction history, holdings level detail, that kind of stuff.
Yeah, it's part of the deal. They're paranoid, rightfully so, and so sometimes a security lever gets tripped that no one even knew about. Really, it could be logged in from a different computer. I find that happens a lot, and then it trips it and it says you have to put your credentials in again. So it's just how it is. Okay, so holdings. I want to start with viewing your holdings in WealthTrace. And I love this screen. I use it all the time. And this is under Investment Insights. And the first tab is Holdings. And it defaulted to showing all the accounts in this little sample demo plan I have set up here. And I really like to look at all my holdings here. I like to see that everything is as I think it should be. I can see the balances by holding and by account and every holding inside these accounts. I can see the percent of the total portfolio, the asset class or asset class mix for the funds and the individual stocks, and even the year-to-date return I can see for these, which I also love to view. We could also do something really neat in here, which is turn off the grouping by accounts and just view everything as one big portfolio. And now we can sort by the percent of the portfolio to see our most concentrated holdings. In this example, the Vanguard Total Stock Market Index Fund is 24% of the entire portfolio. All right, that's a lot, but that's a lot of stocks inside that ETF, so that's not atypical. One thing that might be atypical here, though, is look at all that cash. I've just been sort of alerted in a way that I have a lot of cash. Maybe I know it, maybe I don't, but I'll show you here in a second how to find that out. And then down the line, you can see, the different percentages, Vanguard, information technology. I can see my single biggest stock holding is Amazon at 7.4%. So very useful for that. Now let's go back to grouping by account. And again, I see that cash, and this happens a lot with customers. They say, what in the world? I didn't think I had that much cash. You can just click on the pie chart for cash, and it filters it. Now I can see the accounts it's in and the amounts. Turns out, well, okay, a lot in the CD makes sense. It's cash, pretty much. Savings and checking. These are the big ones. You might say, I had no idea there was that much. I thought I had invested that money, or I thought I had transferred it. Maybe it's hiding in an IRA. I find this happens quite a bit. Your dividends aren't being reinvested, and therefore it keeps going to a cash account. And guess what? Over a few years, all of a sudden you have 50 grand in cash in an IRA and it's uninvested. That is a real bummer when that happens, but you can kind of flesh that out here. When you see my cash, this looks too high, I'm going to filter it. There it is. Now you know what happened. Okay, so that's holdings. I don't really want to go into all the sections of investment insights. I just want to briefly mention that you can also look at your performance for all of your holdings. We go through a lot of trouble to bring this information in, and you can see it year to date. You can see it over various years. I find it very useful just to see how things are doing. You can even compare versus another ticker. So if I want to compare, the small cap index fund here, I can type in maybe a competitor ticker. I can even do single stocks if I want. So it's kind of cool if you're thinking of possibly getting out of one fund and into another. And lastly, you can view the fees you pay on all of your funds, and you can sort by the expense ratio. You can sort by the dollars per year you pay in fees for certain funds. And it's really nice because you can see, like, you might not know in an IRA, it might be hiding, oh my gosh, I'm paying 1% on this fund. I had no idea. Get me out of it. There's an index fund that's 0.1%, right? So I love this screen too. And I don't know if it's used enough, but boy, can you
I
save a
can
lot
I
of
can
money.
say that that screen is not available in any of the advisor institutional tools that are out there. There's a couple of them. I've used all of them, and over the years, over the past 15 years, every time I want to know what my client had in their portfolio, what the expenses are, I had to export it to Excel.
Yeah. Yeah,
So
that's
this is
by
great.
design. Yes, unfortunately. Um, okay, so I also want to mention that you can enter holdings manually into an account. You don't have to link necessarily. It gives a little better information, and it's certainly easier in terms of the labor of it all, but you can add manually. So let me just show you how to do it really quickly. I'm just going to quickly add a taxable brokerage account. I'm in the cash flow input section under investment accounts, and I'm just going to add, I'm going to go to account holdings. I'm going to say enter underlying holdings, and I can start adding here. So let's say I own IBM, ticker's IBM, and you enter the shares, and you have to enter the asset class as well. Eventually, we'll map these asset classes for you based on the ticker, but for now, you have to do that. And the program will go out, we'll use a third party and get the price every time you log in. And it will multiply it by the shares and give you the balance. So you just have to do the one thing you have to update is the shares. That's the downside versus linking, and plus you'll have to if asset classes change, you'll have to update those as well. So it is possible to enter manually. Just delete this. So all this talk about holdings, you might be wondering, well, besides the asset allocation part of it and being able to view performance, what else is it used for? It's used for a lot, and it's very, very important to understand that WealthTrace looks at the holdings level for your annual returns, for the correlations among your investments, and for the volatility of your investments. You won't find this in many other software packages, certainly not for consumers, maybe for advisors, but we are very adamant about looking at the holdings level for accuracy. Now, let me just show you under global settings, you can see one way that we use this. So here are the asset classes. Under asset class mapping, you can see the annual return assumptions. You can change these. If you change a return assumption here, it will flow through to every holding based on its asset class, and that gets rolled up into your projections, and it gets used in the Monte Carlo analysis. So it's pretty easy to change an assumption here and have it flow through. So not only do we have these default asset classes, these first eight through emerging markets, I created a few myself, and you can do this too. I created REITs, I created momentum stocks, and I created something called New York Muni with a 3% yield. Now, why would I do that? Well, there's a New York Muni bond in one of these accounts, and I wanted to get the return right. So watch this. Let me go back to it. And in this account here, this brokerage account, there's a holding for a New York municipal bond. There it is. And guess what? I assigned here the New York Muni asset class that I created. So very detailed. You can be as detailed as you want. And not only does it show up in the asset allocation, but it's now used for projections. Now, Monte Carlo, as I mentioned, also uses some information. Let's go back to global settings. Here are the standard deviations for these asset classes that are used. You can change this if you want. Most people don't, but you can. And here are the correlations as well. So this goes back to the correlations we were talking about earlier, where the diversification happens inside the Monte Carlo simulations. And they are here. And some of them are negative, like bonds with value stocks. Okay, that's great. That's the diversification that I was referring to earlier.
And Doug, with standard deviation, if I added a new asset class in there, I made one up, that would show up in this list here under
I
asset
wish,
class.
I wish
Okay,
maybe in the
working
future,
on that.
hopefully in the future,
But
you have to map it to an asset class. If you create one, you have to map it to an existing asset class for Monte Carlo purposes.
got it, got it. So if I were one of the outliers, and I wanted to throw in Bitcoin, and I didn't have any other emerging market stocks, maybe I would go in and map it to emerging markets, go back into my asset allocation strategies tab, and on top of entering the return assumption for that, I would have to be really, I probably want to put a conservatively high number for standard deviation for something like that. And
Right.
that
Yeah.
way, like return's one thing, but you have to understand volatility.
Right.
And if you're going to bet somewhere, bet that volatility is higher than you think it is.
Right. Yeah. So if you don't have any emerging market stocks and you want to create crypto as an asset class and you say its standard deviation is 30%, you can set this to 30, save it, and then create your crypto and map it like I did for the momentum stocks, map it for Monte Carlo purposes to emerging markets. And that would
That's
suffice.
a great solve. Yeah.
Okay, I said I would talk about rebalancing and reallocating in the software a bit more. And I want to show you, where do you rebalance or where do you set the setting to do it? It's right here under plan settings in the other tab, rebalance investments annually. I have it turned on. So at the end of every year, it will set back each account's mix to where it was at the beginning of the year. So that keeps that drift we mentioned from occurring. Now you can turn it off, but the projections with stocks having a higher return, the drift is definitely going to occur. So I'm going to leave it on. Now, reallocation is a different story. This is reallocating to a new mix. And what I did was I have this plan reallocating to something called mixed allocation 2 at John's retirement. What is a mixed allocation 2? Well, that's a model that comes with the software. You can change it, you can edit it, you can change the name. Here is that breakdown. You can see reallocation at John's retirement. It is 60% in stocks, 40% in bonds. So a little different than what we have today.
Doug,
And
when that happens and you
Mhm.
reallocate, say you go from a more aggressive portfolio because you're working to a less aggressive, a more conservative portfolio because you're retired and you want to manage around sequence of returns, diversification, the kind of stuff we were just presenting on. When you do that here, if you have uh, really low cost basis in your brokerage account, your non-retirement account, um, how does the software account for taxes on that?
yeah, it will track the cost basis as it reallocates. And if it has to sell some stocks at a gain, it
It will
does,
do that.
right? It has to. Uh,
This was a question asked earlier during the
mhm.
webinar, and I think that, and Mitchell, you asked it. It's the software will account for that. And if that throws you into a higher tax bracket because you go from, say, the 15% long-term gains to 20, and then you have NIT or additional taxes because of that, it's going to calculate that. It's going to place those taxes into your cash flow.
Oh yeah, and on that note, just so everyone knows, when you link accounts, the cost basis is updated every day. And I didn't mention that. That is one downside of manually entering, is you have to keep track of the cost basis yourself. So let's turn off this allocation for now and let me show you how you can play around with different models. You can run asset allocation scenarios. In the scenario section, asset allocation, and I'm going to pick a model here. And these models, by the way, you can edit these. Let me go back, actually. Global settings, asset allocation strategies. Here are all the models that we were just looking at. Again, you can edit these. You change the breakdown in terms of the asset classes for the model. You can change the names. You can add your own models and run as many of these scenarios as you want. So I'm going to run one that's really aggressive, right? And I'm going to have them reallocate immediately. So aggressive 2, all stocks, including some emerging market stocks. I'm going to run this, and it's going to run Monte Carlo simulations on the base case and this new allocation. So no surprise to me that the Monte Carlo probability of never running out of money went down. It went down by 10 percentage points. That's a pretty big drop. The worst 25% of the simulations, they have no money. So they run out of money in every one of those simulations in the bottom 25%. Whereas here they at least have a little bit of a buffer. Of course, the upper quartile, the aggressive one, is higher. We expect that, but it's way more dangerous. You can see that here. We can go the other route, super conservative, all cash and bonds. Some people think I'll just be conservative. I don't want to run out of money. Well, turns out it's actually going to give them a higher chance of running out of money. Look at how much the Monte Carlo dropped. It's just not enough return for them. The bottom quartile, they have no money. The upper quartile is way worse than their current allocation. So conservative one, all bonds and cash, is a no-go for them. This would be major trouble for their plan. And that's really the last thing I wanted to show. Feel free to play around in the software, create your own models, run asset allocation scenarios. You can really do a lot with, just seeing how different allocations might impact you over the long run. So let me go back to the presentation. All right. So to summarize, diversification doesn't mean, does mean owning investments that don't all move together. It does not mean, at least as we talk about it, having your money spread out amongst different brokers and banks. A balanced portfolio can really reduce the impact of poor performance in one or more assets, especially during down markets. As I just showed you, if you're too aggressive, yeah, you can increase the growth potential, but the risk might be way too much. Some people can really blow up their plan if they're too aggressive. I showed you how to use WealthTrace to view all of your holdings. You can see the concentrations. You can see the year-to-date returns. You can see the fees you pay. You can really get a lot of good information on your holdings. And of course, you can compare different allocations. You can run scenarios and see how Monte Carlo looks using different allocation models. So thank you, everyone, for joining again. Before we get into me answering some questions, I did want to get back to what Dan was saying about a couple announcements. One, tomorrow we are going to release our first AI agent that will be in the software. You'll be able to do a lot of cool things. First is you'll be able to ask it questions about the software. So, for example, how do I change inflation year by year? It will point you to exactly where you need to go and even give you screenshots of it. How do I view all of my holdings at one time? What is my most concentrated holding? What are my 5 most concentrated holdings? It'll tell you that right on the screen, right on the AI window itself. But you can get more detailed than that, and you can actually run some analysis like, oh, I was running this the other day. What will this 529 plan, what will the balance be when my son is a junior in college? And it will run that for you. Now, I will say one caveat is it's not completely linked up with the WealthTrace calculations yet. It's actually using the AI engine to run some of these estimates. The version 2 will have WealthTrace calculations completely embedded into the AI tool. Oh, and the second announcement is Q4 this year, ETA, a revamped UI and user experience. I know we recently had a new UI. For a variety of reasons, we decided to really go for the best of, like 10 out of 10, best in the industry. This was also due to AI being much more powerful with helping to design things to be super intuitive and customer friendly. And it's going to be amazing. And we are shooting for Q4. And some of you may have seen some emails from me about helping to test out some prototypes. And so look for those because I have one more coming in the next few days.
Yeah, we've been working really hard for the past 7 months on it in the background. So we're
Yes.
super excited because we know what it's going to look like and how it's going to feel. Um, and there's been a lot of investment into it, both in time and money. So, especially with tomorrow, with Trace AI, uh, test it out, log in, give us feedback, send that to support@mywelltrace.com, please, because we want to know. And we're working on a second version of it already that we think is going to maybe blow your socks off in terms of what it can do in an agentic way. So let's move to the live questions. I think we have quite a few. Doug, how do you want
Uh,
to do this?
yeah, well, I already see two that I like.
Okay, go ahead.
One, we sort of talked about asking about uh, leaving some assets alone and compounding over another 30 years can mean a ton of money um, if you're not going to touch that account. Well, if you attended the Roth webinar that we had, I talked about this, and a lot of people they will convert to a Roth IRA or they have money in a Roth IRA and they say, I'm never touching it, I'm leaving it to my kids, and it will not be touched for 40 years. That could be a very good candidate to be more aggressive in that one account potentially. And you can do that in Wealth Trace. You can tell it that you don't want to reallocate in this one account. I guess I could have shown that. I didn't, but you can do it. You can say in this Roth account, I'm never reallocating it. I want it to be 100% in stocks. And you can do that in the software. And it's pretty awesome because that is taken into account in Monte Carlo because it's never touched. That eliminates sequence of returns risk in that aggressive account. So it's a good question, and it is very doable in Wealth Trace.
So I want to spend a moment on that last comment, Doug, because that's really powerful. When we run Monte Carlo analysis, it's running sequence of returns 1,000 different times. If you pull an asset outside of that sequence of returns, and say, I don't need this asset to spend during retirement, therefore don't run the analysis off of it, then that's that's what the question, I think, maybe that's what the question was getting at. Um, I would take the other side of the table on having, say, a single stock, because that was in the question in your holdings. If that single stock is something that you intend to spend on yourself in retirement, then what you are doing is pushing your entire portfolio, depending on how big that is as a part of your portfolio, into one of the outlier situations of either really, really good or really, really terrible. So keep that in mind. But yeah, I think it's pretty fantastic to be able to take an asset outside and say, never reallocate this.
Yes. And actually, I'm getting a lot of questions about the software. I'm going to go back to it. All right. As usual, really good questions. Boy, wish we had more time for some of these. These are really good. Um, How do we determine the default values for expected returns, standard deviations, and correlations for the major asset classes, and do you update them? We just use indices that are those asset classes, and the data is all publicly available, so not hard to make those calculations. We update them annually, and you will get a notification and ask you, do you want to update your returns? Because we don't want to overwrite anybody's returns if they're using their own custom returns. Now, given the software presents in today's dollars, what are the impacts of a higher inflation rate on the portfolios? Well, inflation, it's always calculated with inflation behind the scenes. It's the presentation that will be in today's dollars. So only at the very end is inflation stripped out, just to view it in today's dollar terms. But all the calculations are still using inflation behind the scenes. So it doesn't eliminate inflation. It's just how you're viewing the purchasing power of that money. Now you can switch it off. Someone already asked that. You can always view in nominal dollars, at least the projections. So I'll show you. So turn this off here under plan settings, other. Watch these projections go way up when I do this. There. So no surprise, that's because inflation is now, or they're shown in nominal dollars. Same thing with investments. look at it go skyrocketing to over 6 million, but that's not really 6 million, right? Because a lot of it's inflation. In fact, let's see how much of that's inflation, more than half of it. So I'm a big fan of using today's dollars, but you can switch it. Does the A will the AI leak any of my details to another company? No way. No, no, no. It's all
This is
extremely
in-house, a lot of it.
yeah, in-house, kept very private. Also, everything is masked that needs to be masked. So
Right.
absolutely no account numbers, no real names go in, no so obviously no passwords, nothing like that. So it's we keep it very secure, very safe.
Yeah, we're not third partying this chatbot. It's not another vendor. We control everything to the extent that it's calculated in-house. If it's calculated outside, it's masked, like Doug said. So um, if a question is sent out and the calculation engine needs to reach outside, then uh, it's not Dan's IRA, it's an IRA with this much and these holdings.
Yeah.
When it comes
Yeah.
back, it's unmasked so that it can be applied to Dan's IRA and presented to him in the chat by looking at what he actually has in the app.
Okay, another good question. Is it possible to see all the holdings in a fund, like an S&P 500 fund? No, not yet. I would love to put that in. You'll have to go to Vanguard site to or Morningstar, I think shows I think you can see the holdings there. Or maybe it's just top 20, I can't remember. But I hope we hope to get that in. Are you using a two-step inflation, higher short term and lower later? Well, that's up to you. You can do it. Here it is. Under plan settings, inflation and COLA, toggle this on. You can change that right here. You could say 4%, 4% for inflation and COLA through 2040. And then, I mean, that's pretty pessimistic, but you can do that and you can change it up however you want. So yes, you can absolutely go year by year with the inflation rates. Can you use dollar debasement in addition to inflation? No, not yet. That would only be valuable if you have currency risk. So you have emerging market international stocks that are not hedged, which most of them are not. So no, not we don't have that, at least not yet. Same
But I,
questions
I,
before. Sorry, can concentration across ETFs? Um, no, no individual stock holdings yet. Go ahead, Dan. Sorry.
I was going to say you can still get a lot from nominal dollars and real dollars. So nominal dollars or future dollars. What is my portfolio? What am I going to see on the account statement in 25 years? What is that projected value? And real dollars, today's dollars. What is that future account value actually worth if we take into account inflation? You can you could increase inflation if you want to sort of model dollar debasement um, in a way, and then
Right. But
look at real
I'm assuming
dollars.
they mean dollar de yeah, there's dollar debasement in terms of inflation. And then there's dollar debasement versus other currencies.
Oh,
So I assume that, but that's what they meant. But I'm not sure. Either way, yeah,
yeah,
the big debasement is inflation. The other one is versus other currencies.
yeah. It might be a nice visual. We'll think about that. Um,
Uh, saw I saw a question about disappeared. Okay, now I can't remember what it was, but I was going to answer it. Um, is there an engine to analyze or manage direct indexing? I'm not sure what that means.
so that would be, I'll handle that one. I think that Lewis, that kind of question it's a good one. Indexing is traditionally handled through separately managed accounts by investment managers. So I would just say pay for it. That is something that is if your net worth is in that area of you need more than tax loss harvesting. Um, I even tax loss harvesting, I think it's well worth it to pay for execution. So in the case of direct indexing, hire the lawn service. Don't mow your own lawn.
Yeah. Here's a good one. This is very Timely. During retirement, what's the best way to see how much money I should disperse from each account each year to cover my expenses? Well, there's viewing how it's projected given how you have it set up, which you can do. Let me just show you. So if you go to cash flow projections, investments, cash inflows, I'm going to go to investments by each account. I love this section. I use it a lot. And you can see, you can break it down by each account. So expenses, let's say, paid from your taxable accounts only, taxable, tax advantaged. Let's take a look. Well, this is the balances. So this is how they're being dispersed by account each year. So you can see that, and you can change the order of withdrawals in the investment accounts section. You can reorder these. So I'm going to reorder. I'm going to say, you know what? I want to use the CD first, and I want to use, actually, I'm going to use the savings first, and then checking. So you can reorder these, and then that will flow through to what I just showed you. Now that's how it is, and you can play around and run scenarios and find the scenario that minimizes your taxes or maximizes your Monte Carlo. But that's where AI will help. When the full calculations of wealth trace are really linked in, you should be able to ask, show me the withdrawal order that maximizes my Monte Carlo or minimizes my taxes over this many years. So that's going to be one very powerful feature of AI.
I I think maybe there's an anonymous question in there that maybe just piggyback off of what Doug just said. This question was if we could see the individual stock holdings to see true concentration across index ETFs in all accounts, all of your funds combined to have 30% of your portfolio in NVIDIA. That is a great question to prompt Trace AI with because it knows how much you have in holdings for your index funds. And it also knows in that index fund publicly online has a certain amount of NVIDIA. So it could send mass information out and bring it back in and say, well, based off of how much you own in these index funds, we estimate that you have this much NVIDIA.
That's a really good point. And this just shows the number of potential questions. I mean, I haven't even, of course, I haven't even thought of 99% of the possibilities. That's just one awesome example of the power of AI connected with having everything organized inside the software like this. It's just
And in a
just
private
really
way,
cool.
we've like make no mistake, if there's questions about that, that has been top of our minds, like
Hmm.
security, privacy, that has always been top of mind, and it especially was when we were building Trace AI.
Yeah. Yep. And like I said, should be released tomorrow. And I can't wait to start using it myself. And hopefully, and it is beta, considered beta still, right? This is pretty new stuff, but we wanted to get it out there and let people start using it and give us good feedback on, any issues they run into. Uh, oh, is there a way to build in a black swan analysis other than the Monte Carlo tail? Good question. There is scenarios, bear market. You can choose a previous bear market. This is super duper. This is a black swan 0809, right? I'm gonna click it and it changed the returns. These are the worst 1 year returns during that recession. You can see emerging markets were really hammered during that year. You can even add a market rebound in if you want. And you can run various black swan events here. You can even change these. You can say, I fear that growth stocks will really get hit hard in the next one. So I'm going to set this all the way to -75. So you can play around with these sliders and run your bear market scenario here.
Doug, would you, just in case Lewis, I love these questions, just in case Lewis's question I didn't cover it, the Monte Carlo tail, I believe we've got regular Monte Carlo and then we have Laplace. And could you just quickly describe Laplace for everybody?
Yeah, so under global settings, Monte Carlo assumptions, you actually can choose your distribution. Normal distribution is used in a lot of fields, and it is usually the default for finance as well. But there are many who will say that the tails, the extremes of both ups and downs are fatter than they used to be, so more likely, and that's a Laplace distribution. So if you looked at a bell curve, it would have taller tails, which means more extreme events are likely. Unfortunately, that also means a lower Monte Carlo result, a worse Monte Carlo result for most people, but feel free to play around with it. I do. I just like to see both to understand how susceptible my portfolio is to, um, let's just say a worse, more extreme distribution.
Yeah, and to put that in practice, if you do change it to Laplace, go back to quick scenario controls and Monte Carlo guardrails and get a sense of the sensitivity of your Monte Carlo result when you have a Laplace distribution in place.
Yeah.
Because if it was normal distribution in place and you had added, through quick scenario controls, an extra couple years of life expectancy or a few extra retiring years early or whatever it may be, once you turn it on to Laplace, the sensitivity is going to be different, and it's good to understand at an individual level for yourself how it's different.
Yeah. Yeah. And the fatter the tails, the more important these guardrails become, which Dan was alluding to. And these guardrails are really cool. We did a webinar on this recently, and you can see that if you change your spending when times are tough using these guardrails, it really helps offset the extreme tails in any distribution, but even more so if you switch over to Laplace. I don't see any more live questions. So those were great questions. One popped up. This was one I was going to answer. Are the webinars available? They're all available on our YouTube channel. And Camille's going to answer this as well. So yes, they are. Thanks for
Yeah.
asking that.
Yeah, our YouTube channel, we've got a ton there. I think that I was going to put in a plug for that recent, and I think that uh, if you don't find it there and you'd like to see something recorded about it, email us, send us a live chat during business hours, or send an email to support@mywealthtrace.com. We're always looking for ways to add value, and if it's something that's common enough, we want to add it to the Knowledge Center too.
And two questions just popped up that reminded me to mention one more thing. Asking about analyzing Roth conversions, asking about what a good Monte Carlo success rate is. Depends on the plan. I highly recommend signing up for an expert support session. It's with me, and most people end up doing it. And you can look at the reviews. They are very grateful they did it. To have another set of eyes on your assumptions, to have another set of eyes on um, your results, to run through scenarios with you. It's really, really great, especially when it comes down to Roth conversion analysis and other scenarios that can get really complex really quickly. So that's available, and I really recommend at least doing it one time.
Before
Yeah.
we before we do go, Doug's going to close us out. I did want to just thank everybody for being here. Um, the recording, it will be viewable later this week, and we'll put this on YouTube as well. We're really excited about this Q4 UX UI redesign, and we put a lot of time, like I said earlier, into it. I think that what we need from everybody here is to just help us grow it. We need you to think about how this can be useful for other people and that would be the biggest way for us to continue to provide more and add to what we already have.
Yeah, please spread the word, whether it's Reddit, Facebook, however, it's word of mouth is huge for us. So please do, and that way we can keep adding these great features. So thank you, everybody. Love the questions. It's always a pleasure interacting with our customers. I just love it. So thanks again, and be on the lookout for the AI agent tomorrow.